Imagine two friends, same age, same salary, same city. One of them is driving a brand new car. Leather seats, touchscreen dashboard, that fresh car smell everyone loves. The other one? Driving a 5-year-old sedan that's nothing special to look at. Fast forward 10 years. The guy in the old car has quietly built over $80,000 in investments. The guy in the new car is still making monthly payments on his third financed vehicle. Same income, completely different financial lives. And the crazy part? The guy with the new car genuinely believed he was making the smarter, more responsible choice. So what happened? Here's the story most people tell themselves. I need a reliable car to get to work. And I can't afford to pay cash, so a loan is just how it works. Everyone does it. The monthly payment is manageable. It's fine. And on the surface, that sounds completely reasonable. Car dealers know this. They've actually studied how people think, and they discovered something powerful. Most buyers don't ask, how much does this car cost? They ask, how much is the monthly payment? That one mental shift from total price to monthly payment is one of the most expensive thought patterns in personal finance. Because when you're thinking in monthly payments, a $45,000 car feels exactly like a $350 a month decision. It feels small. It feels manageable. It feels fine. But it isn't fine. And we're going to show you exactly why. Let's break this down with a simple example. Say you finance a $35,000 car. You put a little down, you get a 6-year loan at around 7% interest. Your monthly payment comes out to roughly $520 a month. That feels okay, right? A lot of people spend more on rent increases without blinking. But here's what's actually happening under the surface. Over those 6 years, you'll pay close to $37,500 in total, meaning you paid over $2,500 in interest alone, just for the privilege of driving it now instead of later. But the interest isn't even the biggest problem. The biggest problem is something called depreciation, and it works against you silently every single day. The moment you drive a new car off the lot, it loses roughly 10 to 15% of its value. Not next year. That day. Within the first 5 years, most new cars lose between 40 and 60% of what you paid. So you're making payments on a $35,000 car. That is now worth $18,000. You owe more than it's worth. This is called being underwater on a loan, and millions of people are living this reality right now without even realizing it. You're paying for something that is shrinking in value while the debt stays the same size. Compare that to investing. If you had taken that same $520 a month and put it into a basic index fund instead, at an average 8% annual return over 6 years, you'd have roughly $48,000. Same money, completely different outcome. One path gave you a car that's now worth $18,000 and a loan you just finished paying off. The other gave you $48,000 growing in the background. That's the quiet part of this story that nobody talks about at the dealership. So why do smart people keep making this choice over and over? This is where money psychology gets really interesting. There's a concept called present bias. It means the human brain is wired to feel today's pleasure much more strongly than tomorrow's reward. The shiny new car in front of you feels real and exciting, and now. The $80,000 you might have in 10 years feels abstract, distant, almost imaginary. So the brain picks the car. Every time. There's also something called social signaling. Cars aren't just transportation, they're identity. They tell the world something about who you are, how successful you are, how far you've come. And that feeling? It's powerful. The desire to feel respected and admired is one of the deepest human motivations. Car companies spend billions understanding this. The commercials don't show you loan documents. They show you mountain roads, smiling families, and people who look like they've made it. They're not selling you a vehicle. They're selling you a feeling. And here's the uncomfortable truth. Most people are going into long-term debt to buy a short-term feeling. The new car excitement fades in about 3 months. Studies on happiness and purchases consistently show this. But the payment? That sticks around for 6 years. Now, this isn't about never owning a car or living like a minimalist monk. It's about making the decision with your eyes open. Here's a simple framework to think about it differently. First, think in total cost, not monthly payments. A manageable $500 monthly payment over 6 years is $36,000 out of your pocket, plus interest, plus insurance increases for a newer vehicle. See the full number before you decide. Second, consider the 20% rule. If you can't put at least 20% down on a car, you're starting the relationship already underwater. That's a warning sign worth paying attention to. Third, and this one is underrated, a reliable used car that's 2 to 4 years old has already taken the worst depreciation hit. Someone else absorbed that loss. You get the car, skip the steepest drop, and keep more money working for you. The goal isn't to look wealthy. The goal is to become wealthy. And those two things very often require completely opposite decisions. Back to our two friends. The one driving the old sedan wasn't suffering. He wasn't depriving himself. He just understood one thing that most people don't learn until it's too late. Every financial decision you make is a trade-off. When you say yes to something, you're saying no to something else. That car loan didn't just cost money. It cost options. Investments not made. Opportunities not taken. Financial freedom pushed further away. The most expensive things in life aren't always the ones with the biggest price tags. Sometimes they're the ones with the most convenient monthly payments. Think about that next time you're sitting in a dealership and the salesperson slides a payment plan across the table and says, "It's only this much a month." Because now you know what those words actually cost. Like and subscribe this channel for getting more finance video.